Welcome, everyone, to the Adjusted for Risk podcast here from the shores of Lake Tahoe. So I hope everyone has recovered from eating too much turkey, drinking too much adult beverages, and watching a lot of football. With that, I hope you all had a fantastic Thanksgiving and you were able to give thanks to everything that you were thankful for, and you were able to spend it with family and friends. So there's been a lot of headline-making events this week, starting with Fed Chairman Jerome Powell's speech at the Brookings Institute, the updated release of the Fed's preferred measure of inflation, and a new non-farm jobs report. So let's get started with Powell's comments as equities surged following his speech. Powell signaled that the Fed is ready to slow its pace of interest rate hikes later this month, which markets cheered for obvious reasons. But he also indicated that interest rates will remain higher for longer. The higher for longer statement is not new, as he passed along a similar message during his press conference following the November FOMC meeting. While the indication that the Fed is ready to slow its pace of rate hikes, we're still looking at potentially 3 or maybe even 4 more hikes on the horizon heading into 2023, albeit much smaller hikes than the 75 basis point hikes that we grew accustomed to in 2022. So despite the slowing in interest rate hikes, as the slowing pace, this still leads us to a terminal rate of above 5%. So following his speech, markets are now pricing in a 50 basis point hike during the Fed December meeting here coming up in 2 weeks. So markets cheered it, knowing that potentially the 75 basis point hikes are behind us, and slower rates are or lower hikes are upon us, but there's still some uncertainty ahead. There's no secret that 4-decade high inflation has been the primary catalyst to the steep increase in interest rate hikes that we saw this year. This week's October PCE print provided some support for the Fed to slow down the pace of its rate hikes, while also providing some hope that maybe a soft landing is still a possibility. The core PCE index, which I mentioned earlier is Powell's preferred measure of inflation, rose 0.2% in October, marking the second smallest monthly increase this year. Furthermore, the year-over-year core PCE, the core meaning it removes the volatile food and energy components of the headline PCE reading, came in at 5%, which was a decrease from 5.1% during the month prior. So adding to the promising news is the personal spending. So it's nice that the interest rates are slowly bringing down inflation, but additionally, consumer spending or personal spending rose 0.5% in December, and that is the most since the start of the year. So these reports are promising sign that the Fed's interest rate hikes have slowed inflation without hindering spending. In fact, spending has increased by more per month than it has all year, which is the lifeblood of economic growth. So with this news being very welcome to investors, inflation remains well above the Fed's 2% target, and more work needs to be done. But this report is a promising start. Inflation is slowing, but the interest rate hikes haven't hindered consumer spending, which is really the lifeblood of the economic growth. This week also provided us with the November non-farm payroll report. First of all, Why does it have to be non-farm, right? Why can't we include farmers? My family has a very large farm in South Dakota. Why can't we include farmers in this payroll report? I never really understood that, but that's probably for another discussion. So anyways, we'll stick to non-farm payrolls. As we know, keeping the labor market at full employment is the other objective of the Federal Reserve. Powell has consistently stated that the labor market must become more in balance, which will help slow the pace of wage growth and ease some inflationary pressures. So while the PCE report and personal spending showed positive progress, the jobs report muddied the waters some. Non-farm payrolls increased 260,000 during the month, which was more than forecasts, while wages surged 0.6%. And that 0.6% during the month was the largest monthly increase since January. So this job report continues to show that the labor market remains very tight. Higher wages will continue to be inflationary. This will also make it harder for the Fed to slow the pace of interest rate hikes or even pause them in 2023. So again, some conflicting reports there. The PCE report, very promising, helps the Fed in its to slow its interest rate hikes. The labor market remains very tight and not imbalanced like the Fed would like to see, and that's making it harder for this Fed to slow rates as they try and bring the labor market more in balance, slow wage growth. So they continue to be in a tough spot. While uncertainty remains, the slowing interest rate hikes and positive signs of the resilient consumer spending and softening inflation, I believe equities hit bottom in October. However, while maybe the bottom or the worst is behind us, volatility and uncertainty remains. So it's still not time to get overly optimistic. Continue to be focus on your long-term objectives. So this week, I had the privilege and honor to be part of a panel with Goldman Sachs, Miriam Kamshad, and Chris Gething from Aetherian Wealth Management at wealthmanagement.com's Investment Views Conference. It was a fantastic discussion on building a recession-proof portfolio. The first topic we discussed was whether we're heading for a recession in 2023. While there was no clear consensus on whether a recession is on the horizon, and you're seeing that in the marketplace today, a lot of the firms, Wall Street firms, wealth management firms, thought leaders out there, some are on one side of the spectrum that says, yes, we're sure to see a recession. Then on the other side of the spectrum, no, we're not going to see a recession. So that spectrum is very wide. Markets are pricing in a 60% chance of a recession happening in 2023, which I think is accurate. I do think we are likely to see a recession, but it's going to be a very mild one. The primary theme behind the panel was to be prepared for the uncertain. The Federal Reserve will continue to be the primary driver of market performance in 2023. While the Fed will start to slow the pace of its hikes, the consensus was that there's still more hikes on the horizon, which will continue to slow economic growth. While looking into 2023 and the uncertainties ahead and trying to plan for the uncertain, all the panelists agreed that creating a diversified asset allocation is the primary goal of creating a recession-proof portfolio. When doing so, make sure you keep that big picture in mind. Focus on your clients' long-term objectives and investment goals. Lastly, when money was free, following the peak of the pandemic, with interest rates at zero. Speculation was the name of the game, with meme stocks, increasing 1,000%. Well, with uncertainty high and the uncertainty going to continue, it is not a time to speculate. It's time to go back to being boring. Focus on dividends, companies and sectors that exhibit solid fundamentals, strong balance sheets, and consistent free cash flow. While that may not be as much fun as investing in meme stocks, it will be a very prudent strategy for building a recession-proof portfolio. It's been a while since I taught college football, particularly the Wisconsin Badgers. In large part due to the turbulent year the Badgers went through on and off the field, all culminating in a loss to the hated Gophers. So with that being said, I kind of wanted to ignore the Badgers. Wasn't something I really enjoyed talking about. So that's one of the reasons why I haven't talked a lot about college football over the past couple of months. So putting the on-the-field performance aside, my beloved Badgers made a huge move this week and captured headlines by naming the very sought-after coach Luke Fickell as its new head coach. So while I was rooting for Jim Leonhard, interim coach Jim Leonhard, to get the job for numerous reasons, I was really shocked Fickell finally decided to move from Cincinnati after years of being courted by the likes of the Blue Bloods, USC, Oklahoma, Notre Dame. While the time wasn't right then, now the time is right, and he decided to jump on the Wisconsin Badger job. While most wanted or expected Leonhard to get the job, Fickell is a home run hire. And I think it is very important to get some fresh blood running the program. The program became stagnant under Paul Chryst. It needs to be modernized with some new ideas, and Fickell brings that. So a new era begins, and at the end of the day, I am all for it. Lastly, it's bowl season is upon us after a couple of weeks after the championship weekend, and then we get on to the bowl season. So combine the bowl season with the holiday season, skiing in Tahoe. It is one of my favorite times of year. Granted, it's been pretty cold, but I'll take the cold for the fresh powder and bowl season and the holiday season. With the news that college football playoff will be expanding from 4 teams to 12 teams in 2024, and the uncertainty of how that will impact the Bulls, I'll be enjoying this bowl season, as who knows really how it's going to play out into the future for these bowls, especially the Rose Bowl. I have been very fortunate to go to 2 Rose Bowl games, and they were, let me tell you, they're amazing. Everything that you hear about the Rose Bowl, it's true. Who knows what will happen to the traditional Rose Bowl in the future. But if there's one thing that you can take away from this edition of the Adjusted for Risk podcast, is that if you ever get a chance to go to a Rose Bowl in January, you must do it. It's absolutely, it brings the best of all of college football together, the bands, the students, the football, the setting. It is what college football is all about. So with that, I'm going to leave you with on Wisconsin. And I hope if you're a college football fan or if you have a team, good luck to them during the bowl season. Thank you all for listening and watching this episode of Adjusted for Risk. You can catch the other editions on our Adjusted for Risk YouTube channel, as well as iHeartRadio and Spotify. You can also get more of our insights and research at a wealth of insight from 6,237feet.com blog. So with that, thank you very much. We really appreciate it, and I hope you have a great rest of your week. Thank